I'm recording this late on Monday night, February 9th, 2026, and I need you to pay very close attention to what I'm about to say. Today was not just another trading day. What happened in the silver market today will be remembered for a long time. Silver didn't just move higher, it exploded. Prices surged nearly 6% and closed in the low $80 range, something many traders thought we wouldn't see again after last week's brutal sell-off. And if you held your position through that chaos, through the fear, the panic, the red screens, today probably felt like redemption. Your account turned green again. The stress eased. Confidence started coming back. But right now, there's one emotion that is probably louder than all the others. Temptation. The temptation to sell. You're thinking, I survived the crash. I got my money back. Maybe I should lock in profits before this thing reverses again. And honestly, that thought makes sense. It feels rational. It feels safe. It feels responsible. But I'm going to say something very clearly tonight. Selling right now could be the biggest mistake you make this year. This is not a casual market update. Consider this an urgent warning, a reality check before tomorrow's session opens. Because as strong as Monday was, Tuesday has the potential to be far bigger. What we saw today was just the first shockwave. The real quake may hit tomorrow. Today was the engine starting. Tomorrow could be liftoff. I've spent more than 20 years watching precious metals markets. I've seen rallies, crashes, squeezes, fake-outs, and everything in between. But the setup forming right now going into Tuesday's session is unlike anything I've personally witnessed. Every major force in the market, technical, mechanical, and psychological, is lining up in the same direction, up. And in this video, I'm going to walk you through exactly why, step by step. No hype, just mechanics and logic. By the time we're done, you'll understand what powered Monday's rally and why those same forces are likely to intensify tomorrow. And once you understand that, selling now will feel like stepping off a rocket right after it leaves the launch pad. Before we get deeper, make sure you're subscribed and have notifications turned on, because tomorrow I'll be posting updates as this unfolds live. And share this video with anyone you know who owns silver, because many people are about to make emotional decisions they may regret for years. Now let's break down what really happened today, because Monday's move wasn't random. It wasn't just a bounce or temporary noise. 4 very specific forces drove silver higher today, and all 4 are still active. Let's start with the first one, short covering. During last week's drop, a lot of large traders, especially banks and commercial players, piled into short positions, betting prices would fall even further. But when markets opened Sunday night and silver immediately started climbing instead of dropping, those trades suddenly turned painful. And when short sellers start losing money, they don't have unlimited choices. To exit their position, they must buy back silver. That buying pressure pushes prices even higher, which then forces even more short sellers to cover. It becomes a chain reaction. On Monday, we saw the beginning of that process. The weaker traders closed positions first, adding steady buying pressure throughout the session. But here's the key detail. The biggest players are still trapped. The large institutions with massive positions haven't fully surrendered yet. They're still holding on, hoping prices stall. But the pressure is building, and if prices keep rising tomorrow, many of them will have no choice but to cover. And when those massive positions unwind, the buying won't be gradual. It will hit the market all at once. That's why Monday may only have been the first phase. Now let's move to the second force behind today's rally, pressure from the physical silver market. There's currently a massive gap between prices in physical markets overseas and the paper futures price in the West. In places like Shanghai, physical silver has been trading far above US futures prices. That gap can't last forever. Think of it like compressing a spring. You can push prices down temporarily, but eventually reality pushes back. And the bigger the gap becomes, the stronger the snapback. Monday showed the first signs of that snapback happening. Paper prices are starting to move toward where physical supply and demand say silver should already be trading. And that adjustment process is far from complete. Third, we saw the return of retail investors, what many traders call FOMO, the fear of missing out. After last week's crash, a lot of small investors stayed on the sidelines, afraid of getting burned again. But once prices started climbing sharply today, confidence returned. People rushed back in, afraid they'd miss the recovery. Online searches for buying silver surged. Dealers reported spikes in orders. Social media lit up again. But here's what matters. The big retail wave hasn't even arrived yet. The people buying today are market watchers. The mainstream crowd, people who hear about silver from friends or see it on the news, typically arrive later. And their buying could begin tomorrow or later this week. Finally, the fourth force behind today's move started quietly, but could become extremely powerful tomorrow: option market hedging. As silver pushed above $80, market makers who had sold call options near those price levels needed to protect themselves. To hedge risk, they began buying futures contracts. Today that buying was small, controlled. But if prices keep rising tomorrow and approach higher strike prices, those same risk systems will force them to buy much more aggressively. And those purchases happen automatically, no emotions involved. Computers don't hesitate, they execute. And that mechanical buying can accelerate price moves very quickly. So when you combine early short covering, physical market pressure, retail buying, and the beginning of option hedging, you get Monday's powerful rally. But here's the crucial point. Every single one of those forces becomes stronger if prices continue climbing tomorrow. Monday was the preview. Tuesday could be the main event. And in the next part, we're going to break down exactly why tomorrow could force the biggest players in the market into action, and why that could send prices in a territory very few traders are prepared for. Now let's move deeper into what could unfold on Tuesday, because this is where the situation shifts from ordinary market movement into something far more dramatic. What we saw on Monday was only the easy phase of short covering. Those were smaller traders or funds with tight risk controls exiting quickly once the trade moved against them. But tomorrow introduces a different category of pressure. I call it the existential pain phase. Because now we're talking about the biggest commercial players in the silver market, the institutions that have held massive short positions for years. According to recent positioning data, just a handful of banks control short exposure equal to hundreds of millions of ounces of silver. And many of those positions were built when prices were far lower. So imagine the situation now. If a bank built a short position averaging around $45 or $50 per ounce, and silver suddenly starts pushing toward $85, $90, or even higher, the losses stack up incredibly fast. At that scale, losses aren't just uncomfortable, they become institutional problems. Billions of dollars in paper losses can trigger emergency meetings, internal risk alarms, and regulatory concerns. Trading desks that were profitable for years suddenly look like liabilities. And here's the trap those institutions now face. They can try to push prices back down by adding more shorts, but they attempted that strategy last week and failed. Demand overwhelmed them, and prices snapped back violently. Adding new shorts into a rising market now would only increase their exposure. It would be like trying to hold back a tidal wave with a bucket. Their alternative? Buy back positions and exit. And when institutions holding hundreds of millions of ounces decide to cover, they aren't buying quietly. They are forced into aggressive purchases simply to stop losses from spiraling further. There aren't enough sellers available at current prices to absorb that type of buying smoothly. So prices jump. Stops trigger. More shorts get forced out. Buying feeds on itself. Monday was a trickle of covering. Tuesday could become a flood. And this is only one force at work. Now let's talk about something even more mechanical. Something driven not by emotion or opinion, but by mathematics. Options market gamma hedging. This is critical to understand because it creates moves that seem irrational if you don't know what's happening behind the scenes. Over the past months, market makers sold enormous volumes of call options at strike prices around $85, $90, and even $95. When traders buy those calls, someone has to sell them, and that seller is usually a market maker. But selling call options carries risk. If price rises above the strike price, those calls become profitable for buyers, and market makers lose money. So they hedge. They hedge by buying futures contracts as price approaches those strike levels. And the closer price gets to those strikes, especially as expiration approaches, the more aggressively they must buy. This relationship is measured by something traders call gamma, and gamma increases rapidly near expiration and near strike prices, which is exactly where we are now. On Monday, with silver hovering around $82, hedging activity had started but remained manageable. Market makers were adjusting positions cautiously. But here's where things change. If silver moves toward $84 or $85 tomorrow, hedging requirements rise sharply. Each dollar higher forces larger buying orders. If price then approaches $90, another massive layer of hedging demand activates. This creates what traders call a gamma squeeze. And unlike speculation or hype, this buying happens automatically. Computers run risk models that execute trades instantly. There's no negotiation or hesitation. The algorithms simply buy, and when large amounts of forced buying hit a market with limited sellers, prices can move incredibly fast. Moves that normally take weeks can occur in hours. That's why tomorrow's session has traders on edge. If silver crosses certain price levels, mechanical buying pressure accelerates on its own. Now let's add another force into the equation: institutional FOMO. Retail investors move quickly, but institutions move slowly. Pension funds, asset managers, and sovereign wealth funds don't jump into trades overnight. They debate decisions, run risk models, and wait for confirmation. Last week's crash made them cautious. They stayed on the sidelines. But Monday's rally changed the picture. It suggested the crash was a shakeout, not a trend reversal. It showed buyers stepping back in aggressively. So tonight, inside investment committees and trading floors, discussions are happening. Risk models are being updated. Decisions are being finalized. And tomorrow morning, some of those institutions may start allocating capital into silver. Even tiny portfolio allocations from large funds represent enormous buying pressure. A fund shifting just a fraction of a percent into silver can equal days or weeks of retail trading volume. And unlike retail investors, institutions don't buy slowly once they commit. They execute large orders quickly to secure exposure. So imagine the setup forming. Banks forced to cover shorts. Market makers forced to hedge. Institutions beginning to chase performance. All converging at the same time. And none of this even accounts for what's happening in the physical market yet, which we'll dive into next. Because the disconnect between physical silver supply and paper pricing may become the final accelerant. And once that realization spreads, the reaction could push this market into territory few investors are prepared for. In Part 3, we'll break down how physical shortages, media coverage, and panic buying could collide with these technical forces, and why tomorrow may only be the beginning of something much bigger. Now we need to talk about the force that sits underneath everything else, the foundation of this entire move, the physical silver market. Because no matter how powerful futures trading, options flows, or hedge fund positioning become, real-world supply and demand eventually win. Paper contracts can influence prices for a while, but they cannot permanently override physical reality. And right now, that reality is becoming impossible to ignore. There is a massive price gap between physical silver trading in Asia and the paper futures price in Western markets. In certain markets overseas, buyers are already paying dramatically higher prices to secure real metal. That difference isn't just a curiosity. It's a warning signal. It tells you that the physical market is tighter than most people realize. And here's the key point. When physical buyers cannot obtain metal easily, panic buying begins. Dealers run out of inventory. Delivery times stretch from days to weeks, sometimes months. Premiums explode as customers compete for limited supply. We are already seeing early signs of this. Online dealers reported surges in orders after Monday's rally. Some websites slowed down or temporarily crashed due to traffic. Inventories that seemed comfortable 2 weeks ago are suddenly being drained. But tomorrow is when awareness spreads beyond metal enthusiasts. Because financial media is always reactive. It reports what already happened, not what is about to happen. On Monday, most outlets were still cautious, talking about volatility and recovery. On Tuesday morning, that tone changes. Major financial networks will wake up to headlines about silver's rebound. Charts showing the sharp recovery will appear everywhere. Analysts will start discussing supply deficits and the widening gap between global prices. Segments will run showing dealers reporting shortages. And once mainstream coverage starts, an entirely new class of buyer appears. People who have never followed silver before. Office workers who hear coworkers talking about it. Casual investors scrolling headlines. Viewers watching financial news who suddenly decide they don't want to miss the next big move. This wave of buyers is driven by emotion, not analysis. They don't understand short squeezes or options hedging. They simply see prices rising and feel urgency to participate. And their buying often arrives right when momentum is strongest. Now combine this with what happens when physical supply tightens. Investors who try to buy physical metal may discover delays or limited availability. So they turn to alternatives, ETFs, futures exposure, or mining stocks, anything connected to silver's price. Ironically, the inability to obtain physical silver drives even more buying in paper markets, which pushes paper prices higher, which then narrows the gap with physical prices. And once markets realize that physical supply constraints are real, confidence in paper pricing begins to erode. Traders start asking uncomfortable questions. Why is physical metal so much more expensive? Can futures exchanges really deliver enough silver if everyone demands it? What happens if delivery requests spike? Whether or not those fears are justified doesn't matter in the short term. Perception alone can drive massive price movement. Markets move on belief as much as reality. And if tomorrow becomes the day when investors collectively begin doubting paper supply, buying pressure could accelerate dramatically. But that's still not the final layer, because momentum feeds on attention, and attention is about to increase. As prices surge, social media lights up. Influencers, commentators, and trading communities amplify the story. Screenshots of gains circulate. Forums fill with excitement. Then comes the final stage of a parabolic move, late money. Investors who ignored the move earlier suddenly rush in, afraid they've already missed too much. They buy not because valuations make sense, but because prices are moving. That buying often arrives right at peak momentum, pushing markets to levels that feel irrational. And tomorrow afternoon could be exactly when these forces collide. Short sellers scrambling to exit, market makers forced to hedge, institutions entering positions, retail buyers chasing headlines, physical shortages driving panic, all hitting at once. And this convergence is what creates historic trading sessions. Which brings us to the most important question. What should you actually do? Because understanding the mechanics is one thing. Acting correctly under pressure is another. And in Part 4, we're going to break down the tactical decisions, what holders of physical silver should do, what ETF investors should consider, and the biggest mistake traders make during explosive moves. Because the opportunity here is massive, but so is the potential regret if you move at the wrong time. So now the final question becomes simple, but incredibly important. What do you actually do next? Because information alone doesn't make money in markets. Decisions do. And explosive moves like the one potentially unfolding create emotional pressure that causes people to make mistakes. Let's walk through this calmly and logically, based on where you personally stand. If you own physical silver, the strategy is straightforward. Do nothing. You already hold the asset everyone may soon be chasing. You survived the volatility, ignored the fear, and kept your position when others panicked out. Now price discovery is starting to catch up to the physical market reality. Selling now, before price alignment happens, would defeat the entire reason for holding physical metal in the first place. This phase is where patience gets rewarded. Let the market come to you. Now, if you own silver through ETFs or unleveraged paper exposure, the decision becomes slightly more tactical. Yes, the temptation to take profits is strong after a sharp rally. Watching gains appear after stress naturally makes people want to protect them. But markets don't usually stop after the first breakout. If silver convincingly breaks above major resistance levels, especially the mid-$80s zone, momentum traders, institutions, and mechanical hedging flows could push prices significantly higher. One smart approach is scaling, not exiting. Instead of selling everything, consider taking small profits only at much higher levels while keeping your core position intact. That way, you participate in further upside while still locking in gains if momentum continues. The key mistake investors make is leaving the table too early. They celebrate a quick win, only to watch prices double afterward without them. Now, if you're currently sitting in cash and wondering whether it's too late, the answer is complicated. The best entry points are always when fear is high and prices are low. That opportunity existed during last week's crash. But markets don't wait forever. Buying after a breakout is risky because pullbacks can be violent. Even during powerful rallies, sudden drops of $5 or $10 can occur in minutes due to algorithmic trading and thin liquidity. So if you decide to enter now, position size matters. Only commit capital you can tolerate seeing fluctuate without panic. A smaller starter position allows participation without emotional stress if volatility hits. And this brings us to the most critical warning of all. Do not use leverage right now. This cannot be emphasized enough. Leverage works both ways. Even in a strong upward trend, markets experience violent intraday swings. A quick drop triggered by algorithms or profit-taking can wipe out leveraged traders in minutes. Many investors correctly predict direction but still lose money because leverage forces them out before the move completes. Your goal is participation and survival, not maximizing risk. Unleveraged positions allow you to ride volatility without being forced out. Now let's step back and look at the full picture. Monday's rally was driven by initial short covering, renewed retail interest, early hedging flows, and physical market pressure. But tomorrow brings something potentially larger. Major banks facing rising losses may be forced to exit shorts. Option market hedging could accelerate as key price levels are crossed. Institutions may begin allocating capital after confirmation of strength. Media coverage will likely attract new buyers. Physical supply concerns may intensify. All these forces converging at once create the type of session traders remember for years. And that is why selling too early could become a painful memory. I've spoken with countless investors who exited positions right before major runs. Many still regret those decisions years later. Markets occasionally offer moments where patience matters more than speed. This could be one of them. So here we are. The case has been laid out. The mechanics explained. The risks acknowledged. The opportunity defined. Now the choice belongs to you. But understand this. Moments when market structure, momentum, psychology, and supply dynamics align are rare. And when they do occur, price adjustments can happen extremely fast. The physical market has been signaling stress for months. Paper markets are only now beginning to respond, and that adjustment process may just be starting. So hold steady. Don't panic on volatility. Don't flinch on pullbacks. And don't let short-term fear push you out of a potentially historic move. Stay alert, stay disciplined, and be ready for a session that could reshape how people view the silver market going forward. This is the moment long-term holders have waited for. And now we watch how it unfolds.